back in 2014, a new technological change happened for oil and gas. It's called horizontal drilling or fracking. And that technological change did a couple things. Number one, it changed the pricing structure for how oil and gas services would work. And number two, based upon all the capital that was raised, now all of a sudden capital dried up because the pricing structure collapsed. And so what we have in software is very similar. We have a technological change which is forever going to change how software is going to be priced. Now we should think about that industry. And based upon that technological change and how much leverage is in the broadly syndicated loan market, and then more importantly in the direct lending market, leveraging up these software companies, the capital's now drying up. And so what did we see as a result of that technological change in oil and gas? We saw a 15% default rate in the subsequent years, 2016 and 2017. So for me to say that software, which is the biggest sector within the direct lending business, couldn't get to a 15% default rate, I think is actually missing the mark, because I think that's exactly what's going to happen in years 27, and it has a chance of happening in 27 and 28 to have back-to-back years. So although the industries are very different, there's a lot of similarities because of technology changing how pricing structure works at a time when too much capital has been flooding into the sector. Just think about this for a second, Matt. Only 1% of companies in the U.S. are software companies, and only 7% of all publicly listed companies are software. Yet, 23% of the direct lending business is software. How did we get there? It was a gold rush to finance these software companies and these buyouts. And the public companies are sitting in good shape because their debt, and we look at NASDAQ, S&P, Russell 2000, the debt that these software companies have with really good margins, the debt that they have is only 0.5, less than 1 turn of leverage. In the broadly syndicated loan market, you have 5 turns of leverage, 10 times the leverage. Right. In the direct lending business, you can have 20 times the leverage, so you don't have the companies that can generate the free cash flow to reposition for AI. They're in a very tough position.
So, Bruce, what is the effect of that? I think a lot of investors are reading your research and starting to wake up to the fact that this could become a reality, and as a result, we're seeing redemptions. People are trying to get out of these illiquid private credit funds. And what we see some of these companies doing, Blue Owl, for example, is, okay, we're going to sell a ton of these assets. We're going to sell these loans. And they want to be able to say, we got, 99%, we got 98% of the par value for that. So they can't be selling those 20 times EBITDA software loans, right? They must be selling their best assets.
Yeah. So I can't speak to Blue Owl or others that
of course
have
not.
Liquidity crisis or liquidity issue right now in their funds. It's something I'm not focused on. What I am focused on is the availability of capital on the back end of this to extend these loans. And I believe that there won't be availability of capital. So I think the next round in the years 27, 28, when a lot of these loans come due, is in the direct lending business to extend and amend or extend and pretend to pick those loans because it won't have the cash flow.
Payment in kind financing.
And you won't you won't get paid back in interest. And because you've extended the loans, you also won't be getting paid back in principal.
What does that do to an entire industry that is both private credit and private equity that has loved software, that has gotten it to 23%? If all of a sudden they can't go to capital markets and they can't get those loans, the financing ceases to exist, what does that do to the industry?
I think the industry is fine because I think direct lending is a big industry, and I think that there are other sectors of the economy. Again, software is only a few percent of the overall economy.
But it sounds like you're saying software lending is over. It's done after this episode.
I think when you lend in software, you have to lend at very conservative multiple because the business itself is an uncertain business. And so 4 times debt to EBITDA, not 10 times, is probably the right number, and getting paid a little bit more for that risk, an extra 100 basis points on your loans. Now, to the extent that financial conditions tighten a little bit on this in the direct lending space because of what's going on, we can get paid more for loans that we're making in the marketplace with tighter covenants. So I think for lenders that aren't in a bad position that actually can extend credit, it's actually a good place to be. And so I wouldn't let software, just like oil and gas, when you had that problem with those companies back in 2016, 2017, 2018, didn't tank the economy. The economy is just fine. I think the economy will just be fine without having to deal with the default rates that are coming, the problems that are coming, because the economy is so much bigger and diverse than this. And so it's not going to do anything to cause any kind of disruption to the broader private credit markets or the broader credit markets or the economy. I don't believe that at all is the case, but what it will cause is religion to come back in, a discipline to come back in, because quite simply, you know, Danny and Matt, 23% of software is just too much exposure to one industry group when it only represents a very small part of the overall, equity markets. It's only 1% of all companies in the U.S. are software companies, and only 7% of all publicly listed companies in the U.S. are software companies. So it's too much exposure for them to have had. Everyone regrets it now. We're thankful that we have 1% exposure.
We have your cost.
And not that type of exposure. It's going to represent some really good opportunities for us as lenders in the years to come, Danny.
Well, I'm wondering, where those opportunities are going to be, and specifically in software, because religion has already set in with some of these names. Are there some you think that are oversold? Are there some that you think, the debt is cheap enough to go in and pick it up? Because that's historically where you've made a lot of money, Bruce.
First of all, I think in the public equity markets, they're going to be in a really good position to buy a lot of this at pennies on the dollar, because they're the ones that are going to have the capital, the cash flow, the margins to be able to do so. Smart private equity will also come in and recapitalize and buy new companies, but they'll pay a lot less. The whole ratings of where, what multiples you pay for the company has come down substantially, and private equity traditionally doesn't pay more than 12 times for a company, traditionally. And so getting the whole sector repriced based upon this existential risk that you have. Look, private equity is important, and that's where we're moving towards. And the second thing is private equity has all the upside. Imagine a company through creative disruption that they can reposition, instead of making 2 or 3 times their money, they make 5 or 6 times their money. So they can afford a few zeros, right? And still come out okay. Private credit can't afford the zeros. They only get paid back par. They don't have the upside. So what you need, Matt, is certainty when you lend. It's an uncertain business right now, and that's why capital will not become available.
So are you not buying anything then?
Not right now in software. What we're focused on are businesses where Halo is the effect.
Hard
assets, low obsolescence. I'm talking about in lending. Our last private credit lending deal in DL was a concrete deal with rebar. The deal before that was sod for commercial and residential that you lay on the lawns, right? And so these are real asset lending opportunities. And our last asset deals in our ABL business, hard assets, low obsolescence, are aircraft, maritime assets, turbines, cranes, and engines.
Because you're bullish the economy.
Because we love the economy, and we want to be able to lend, say, at a $300 million asset pool, $200 million on an LTV basis, a 66% LTV, that nice margin of safety with that hard asset where we have a perfected interest in that hard asset. It's not software where the recovery value will be close to zero if there's a default. We get full recoveries in the event of a default on most of those assets. And we very rarely have a default because they're missing critical assets for these companies. And so it's a very different dynamic when you talk about Halo. And with Halo, that's why you see industrials and materials up 25% in the year, when a lot of the software companies are down 25 to 40% in the year when you talk about the mid-market software companies. And so we're in a very good position at Marathon as a lender with capital available to lend and with how our position is currently positioned.